Hello everyone, welcome to Learn Business with SHMSS. Today we are going to see a very important topic that is depreciation. This is a very popular topic and all the accountants and finance professionals will come across this topic, and this is a very important topic which decides the net profit. So let us go in detail about this topic. What is depreciation? Depreciation is a systematic allocation of cost. Actually, it's a systematic allocation of cost of tangible asset over its useful life. I have highlighted 4 words in red color to understand more about depreciation. These 4 words are very important to learn. The systematic allocation is the methodical approach. There are 4 methods to calculate depreciation. We will learn it in the next couple of slides. So we cannot spread the cost without any proper way. So we have a proper way to allocate the cost. The cost is the normal purchase price of the asset, and tangible asset is the asset which can be touched and felt. So for example, we can say a car, a machine, a building, and we can touch and feel. So these are called tangible assets. And over its useful life is number of years that asset is going to be with us for and generate income. So to distinguish tangible and intangible, I have given the intangible assets also. For intangible assets, we don't use depreciation, we calculate amortization. So only for tangible assets we use depreciation method, and for intangible assets we use amortization. Intangible assets are assets that cannot be touched and felt. For example, we can say policies, goodwill, software, we cannot touch and feel, so we call it intangible assets. Example for depreciation is that a company can buy a machinery for higher amount and it cannot charge or book the entire amount. For example, let's say we buy it for $10 million, we cannot charge or book those $10 million in one accounting period, because it will show a huge difference in our profit and financial position of our company. So that we use a systematic method to spread the cost for the certain number of years, for example 10 years, 100 years, 50 years, 5 years, and to reduce the effect or to reduce the net effect on our company's performance and position. And there is a picture I have shown you in the slides, which is a set of machineries that have been bought by a factory. It's just an example. And let's say these machineries are bought for $1 million USD, and the useful life of those machineries is 10 years, and the company may charge 100,000 per annum as a depreciation and write off it, or they can charge 8,333 per month and write off it from the income statement and show the net effect in the balance sheet as net book value. In the balance sheet, mainly there are 2 financial statements that are going to be affected by this depreciation. The first one is the income statement, and second one is the balance sheet. Income statement will have depreciation part, and which will also reduce the net profit, that will influence the net profit part. This will ultimately reduce the net profit. And balance sheet, the second financial statement is going to be affected. That will be affected in the portion of fixed asset as a net book value. So the accumulated depreciation will be deducted from the gross amount of the fixed asset, and net book value will be reported in the financial position of a company. In the third slide, we will see what are the methods that we already spoke about it in the previous slide. What are the methods available to calculate depreciation? As we already saw that In the definition of depreciation, it's a methodical approach or a systematic process. So what are the methods available to calculate depreciations? There are mainly four methods to calculate depreciation, which is recommended by generally accepted accounting principles guidelines. The first one is the straight line method. This is a very popular method, and reducing balance method, in other words, we call it declining method. Sum of the year's digits, units of production. We will learn about these methods of calculating depreciation in our future videos. The next topic is the accumulated depreciation. This is also a very important term, very popular term that we have used in our previous slides, and we will use it in the future videos also. And having an understanding about these terms are very important for accounting professionals. So because this will play an important role in your profession, and this is a very important uh, part, and you will play with this, you will calculate this in your profession. So accumulated depreciation is simply the total amount of depreciation that are recorded for an asset on a company's balance sheet. So this is a very easy thing, very easy to calculate. This is just adding up each year, each month's depreciation for an asset. For example, let's say we buy an asset for $1,000. We depreciate it. We allocate a depreciable amount of $20 each month. So the income statement will have depreciation expenses. Year 1 it will have $240. Year 2 it will have $240, and accumulated depreciation will be at the end of year 2 will be $480. How it has come 240 year 1 and year 2 240, total up to 480. So when we are calculating net book value at the year 2, we know what is the equation for the net book value: cost minus accumulated depreciation. So cost is 1000 is shown here, and minus accumulated depreciation is 480. We get $520, which is the net book value will be reported in the statement of financial position or balance sheet. All right, we'll go to the next topic, which is double entries for depreciation. We know double entries, debit and credit. So when dealing with depreciation for double entries, at the time of, let's say we buy a motor car for $15,000, and depreciation is $3,000 per annum, and useful life is 5 years. We have all the information here. What we have to do, we have to just make the entries for this transaction. When we purchase the car, the fixed asset will automatically increase by 15,000. Or in other words, we say motor vehicle account will increase by 15,000. So we debit 15,000, and cash will reduce by 15,000. So we credit cash account by 15,000. In the first year, we calculate depreciation. Let's say we bought it on the first day of the year, first day of the financial year start. So we on the year end, we calculate the depreciation is 3,000, and we charge to the income statement, and net profit will be reduced by 3,000. At the same time, simultaneously, we have to make an entry in the accumulated depreciation by crediting that account by $3,000. And year 2, we have to charge $3,000, and year 2, same again, we have to credit $3,000 in the accumulated depreciation account. Then the total credit of the credit balance of the accumulated depreciation account will be 6,000. Likewise, we have to do it for next 5 years, and at the end of 5 years, the accumulated depreciation credit balance will be $15,000, which is equal to the purchase price of the car. Right. Let us go to the next topic. How the balance sheet will be affected because of this depreciation. I have given you the extract of the calculation that, or the table that we used for double entry. Let's say how the net book value will be affected. We know what is the net book value calculation, which is net book value is cost minus accumulated depreciation. We know that. So the same equation will be applied here. So in the year, at the year one, I mean what I'm referring to years, like year 1, year 2, year 3, you should consider that year end, at the year end of first. Let's say the net book value will be 15,000 minus 3,000. 15,000 is the cost of the vehicle. 3,000 is the net book value, or we can have it 3,000 net book value. We get 12,000. At the year end, at the second year end, 12,000, we take it as an open, last year's closing balance is this year's opening balance, 12,000 minus 3,000, we get 9,000. Oh, in other words, we also can directly deduct the accumulated depreciation. That is the real way. But for explanation purpose, I am doing in this way. Normally, when doing this one, let's say we take the cost, which is 15,000 minus 3,000. So we get 12,000. Again, at the year two, what we are going to do, we get 15,000 and 3,000. Sorry, 6,000. We get 9,000 here. And the year 3, 15,000 minus 9,000, we get 6,000 here. So likewise, we calculate until year 5. So we get 0 at the 5th year end. So this is the way to calculate the fixed asset, or the net book value of the fixed assets. If you have any questions, you can comment below so that I can add that and clarify it in the next upcoming videos. Now, thank you for watching my video, and please subscribe, share and like my video. Please don't forget to subscribe my video and press bell button for notification of future video uploading. Thank you very much.